Cigna is one of the largest health services companies in the world, but understanding it requires separating the two very different businesses inside the same ticker. A pharmacy benefit manager that processes $200 billion in drug spend annually, and a health insurance company covering 35 million people through employer plans and Medicare Advantage. The pharmacy business has almost nothing to do with the insurance business, except that they share a balance sheet.
The defining transaction of modern Cigna was the 2018 acquisition of Express Scripts for $54 billion. Express Scripts was the largest independent pharmacy benefit manager in the United States, processing prescriptions for over 100 million Americans. Cigna renamed the combined pharmacy and specialty services unit Evernorth. Today, Evernorth generates approximately 75% of Cigna's revenue.
The original Cigna was formed in 1982 through the merger of Connecticut General Life Insurance and Cigna Corporation, two companies with roots going back to the 1860s. That employer-focused health insurance heritage forms the foundation of what is now the Cigna Healthcare segment: commercial employer health plans, Medicare Advantage, individual market coverage, and international health insurance for corporate clients.
The pharmacy benefit manager model that Evernorth operates is fundamentally a middleman business. PBMs negotiate drug prices between pharmaceutical manufacturers, retail pharmacies, and insurance plan sponsors. They generate revenue from administrative fees, rebates from drug makers, and the spread between what they pay pharmacies and what they charge plan sponsors. The Express Scripts network processes over 1 billion prescriptions annually.
David Cordani has been president and chief executive officer of Cigna since 2009, 16 years running the company through the transformative Express Scripts acquisition and the current managed care cost cycle. Cordani joined Cigna in 1991, rose through finance and operations, and has been the architect of the dual-segment strategy that makes Cigna simultaneously a PBM powerhouse and a major health insurer.
The Evernorth PBM moat is built on contract scale, data, and integration. Express Scripts manages drug formularies, the list of covered medications for employers, unions, and government programs. The larger the PBM, the greater the negotiating leverage with pharmaceutical manufacturers, and the lower the drug costs for plan sponsors. With over 100 million covered lives, Express Scripts is one of three dominant PBMs alongside CVS Caremark and United Health's Optum Rx.
The GLP-1 drug wave is an Evernorth revenue catalyst that analysts are still modeling. As Ozempic, Wegovy, Mounjaro, and similar obesity and diabetes medications scale from 20 to 40 million American patients, every prescription flows through the pharmacy benefit management network. Evernorth processes the administrative revenue, manages the formulary position, and in many cases dispenses through its specialty pharmacy, capturing margin at multiple points in the supply chain.
Cigna Healthcare's medical cost ratio, claims paid as a percent of premiums collected, is the defining profitability metric for the insurance segment. When medical utilization runs higher than expected, the MCR rises and margins compress. The managed care sector has faced elevated MCR pressure from deferred care normalization, rising behavioral health costs, and Medicare Advantage rate recalibration. These dynamics have periodically compressed Cigna Healthcare margins and pressured reported earnings when medical cost cycles turn.
The financial profile reflects the PBM model. Enormous revenue, thin margins. Free cash flow was $8.39 billion in FY 2025, roughly 3% of the $275 billion in annual revenue. This is typical for health services companies, where most revenue flows through to drug costs and medical claims, with operating profit extracted from the small spread. The business generates real cash. It just doesn't show impressive margin percentages.
The competitive radar shows Cigna's strengths and vulnerabilities clearly. Evernorth scores high on PBM scale and specialty pharmacy expertise. The Cigna Healthcare employer commercial business scores well on network size and employer relationships. The vulnerability: United Health Group's Optum unit has built a more integrated care delivery network, owned clinics, physician groups, and ambulatory surgery centers that Cigna does not yet match.
The capital allocation story at Cigna is dominated by Express Scripts leverage management. The $54 billion acquisition was funded with significant debt. Since then, Cigna has prioritized debt reduction and selective buybacks. FY 2024 included $7 billion in share repurchases, one of the largest single-year buyback programs among S&P 500 healthcare companies. FY 2025 buybacks dropped to $3.62 billion as capital was balanced between debt reduction and returns.
The dividend history shows a company growing its payout consistently, from $4 annually in 2021 to approximately $6.09 TTM in 2025. At a price of $285 and a yield of 2.1%, Cigna trades at a valuation that reflects both the PBM revenue scale and the managed care margin uncertainty. The stock has been pressured by the sector-wide medical cost cycle that began in late 2024.
The international health segment is an underappreciated part of the Cigna story. Cigna International Health covers globally mobile employees for Fortune 500 corporations across 30-plus countries. This business has lower medical cost ratio volatility than U.S. commercial insurance because of pricing discipline and the demographics of corporate expatriates. It is growing at mid-single-digit rates and provides geographic diversification.
Cigna built its position by recognizing that the American healthcare system's complexity creates intermediary value. Employers need someone to manage drug costs, administer benefits, and keep employees healthy enough to stay productive. Evernorth manages the pharmacy side of that equation. Cigna Healthcare manages the medical side. Together, they serve approximately 200 million customer relationships, a scale that makes Cigna integral to how America pays for healthcare.
The thesis on Cigna is a two-part bet: that Evernorth's PBM moat holds through regulatory scrutiny, and that Cigna Healthcare's medical cost ratio normalizes as 2026 and 2027 contract renewals embed current loss experience into new pricing. At 10 times forward earnings and 0.27 times revenue, the market is pricing in meaningful execution risk. But for investors who believe the cycle turns, the discount to historical multiples is the setup. Cigna reported Q1 2026 revenue of $68.5 billion, beating the $66.3 billion estimate by 3.3%. But adjusted EPS of $6.26 missed the $7.62 estimate by $1.36, a 17.8% shortfall. The largest quarterly EPS miss in Cigna's recent history. Medical costs ran hot. The stock, already down 18% from its 52-week high, opened lower.
Cigna Corporation was formed in 1982 through the merger of Connecticut General Life and INA Corporation, two of America's oldest insurance companies. Today, Cigna operates as the Cigna Group, one of the largest health services companies in the world, with 71,000 employees and approximately $275 billion in annual revenue.
At $75 billion in market cap, Cigna runs two core segments. Evernorth Health Services, anchored by the Express Scripts Pharmacy Benefit Manager acquired for $54 billion in 2018, represents approximately 75% of revenue. Cigna Healthcare, the health insurance business serving employers, Medicare Advantage, and individual markets, represents the remaining 25%. The division of pharmacy services and medical insurance under one roof is Cigna's defining strategic bet.
Q1 2026 revenue of $68.5 billion beat the $66.3 billion estimate, a 3.3% outperformance. Year-over-year revenue growth of 4.6% versus Q1 2025 was driven entirely by Evernorth volume growth. But it was the EPS line that dominated the quarter. Adjusted EPS of $6.26 versus $7.62 expected, a miss of $1.36 or 17.8% below consensus.
The miss was driven by the medical cost ratio in Cigna Healthcare. Medical loss ratios, claims paid as a percent of premiums, ran above expectations across commercial employer and Medicare Advantage portfolios. This is the dynamic that hammered Humana and Elevance in late 2025. Utilization recovering faster than premium pricing can adjust, particularly in behavioral health and specialty drug administration.
Evernorth performed well. The Express Scripts PBM processed record specialty pharmacy volume as GLP-1 drugs, oncology agents, and biosimilars drove script growth. Evernorth revenue grew at approximately 5% year over year. The problem is that PBM economics are thin. Evernorth generates enormous revenue but delivers low single-digit operating margins, meaning the pharmacy flywheel cannot offset a healthcare margin shortfall.
Annual free cash flow was $8.39 billion in FY 2025, down from $8.96 billion in FY 2024. Cigna repurchased $3.62 billion in shares during FY 2025, down from the $7.03 billion in FY 2024, which was among the most aggressive buybacks of any S&P 500 company that year. The pivot toward debt reduction limited buyback capacity in 2025.
The balance sheet reflects the Express Scripts leverage. Total debt of $31.5 billion against cash of $7.7 billion equals net debt of $23.8 billion. Total equity is $41.7 billion. Net debt at 0.57 times equity, elevated but manageable given the cash generation profile. Long-term debt of $30.9 billion is the legacy of the $54 billion acquisition that built Evernorth.
Quarterly revenue over 5 periods. Q1 2025, $65.5 billion, Q2, $67.2, Q3, $69.7, Q4, $72.5, Q1 2026, $68.5 billion. The Q4 to Q1 dip is seasonal. Fourth quarter carries peak pharmacy volume. The 5-quarter trend remains positive.
David Cordani has served as president and chief executive officer of Cigna since 2009, 16 years running the company through the Express Scripts acquisition, the pandemic, and the current managed care cost cycle. Cordani is also chairman of the board. His compensation structure ties realized pay to adjusted EPS growth, revenue expansion, and customer retention targets, incentives aligned with the long-term compounding thesis.
Analyst consensus on CI is hold. 14 buy ratings, 9 holds, and 3 sells. The average price target of $333 sits 16.5% above the current stock price of $285.71. This is a rare setup. The stock has sold off so far that analyst consensus is now notably above the current price.
The bull thesis is valuation-driven. At 10 times forward earnings and 0.27 times revenue, Cigna is trading at the cheapest levels it has seen since the Express Scripts acquisition closed. The managed care sector trades at 12 to 15 times in normal conditions. Bulls argue the medical cost headwind is cyclical. 2026 contract repricing will reset the healthcare margin, and the stock is priced as if the business is permanently impaired.
The cautious view centers on the earnings revision cycle. The Q1 2026 miss was the second time in recent quarters that CI underperformed on the EPS line. Managed care companies with recurring medical cost misses tend to see multiple rounds of downward revisions before the bottom is found. If medical cost ratios remain elevated through Q2, another guidance cut is likely.
Deutsche Bank and Barclays have maintained price targets in the 320 to 340 range with buy ratings. Morgan Stanley has an equal weight at 315. The sector dynamic is important. United Health Group, the dominant managed care company, also flagged medical cost pressure in its recent quarter, suggesting this is industry-wide normalization rather than a Cigna-specific execution failure.
The consensus takeaway: CI's discount to sector peers is the opportunity if the medical cost cycle is peaking. Evernorth's durable PBM revenue provides a floor on earnings even in difficult healthcare quarters. The question analysts are asking is whether the medical cost ratio peaks in Q1 or continues into Q2 and Q3. That answer will determine whether the stock's discount closes or widens.
The bull case is a 10 times earnings compounder with a durable PBM moat. Evernorth manages approximately $200 billion in annual drug spend for Fortune 500 employers, unions, and government programs. Express Scripts is one of 3 dominant PBMs alongside CVS Caremark and Optum Rx, a structural oligopoly with multi-year contract renewals. That revenue base does not disappear because of 1 quarter of medical cost pressure.
The repricing cycle is the catalyst. January 2027 employer contract renewals will embed Q1 2026 loss experience into new pricing. This is standard insurance dynamics. As higher-priced contracts replace repriced ones, Cigna Healthcare's medical cost ratio normalizes. Historical managed care cycles show an average 18-month recovery from trough MCR to normalization.
The GLP-1 drug tailwind is an ever-north revenue driver that analysts are still early in modeling. As GLP-1 prescriptions grow from 20 to 40 million American patients, each prescription flows through the Express Scripts network, generating administrative revenue, specialty pharmacy margins, and rebate income without medical claims exposure.
The bear case starts with PBM structural risk. Federal legislation targeting pharmacy benefit manager rebate transparency, spread pricing, and mail-order pharmacy requirements has moved further through Congress than at any prior point. A material PBM reform bill could remove the rebate retention economics that generate a significant portion of Evernorth's operating profit. The regulatory ceiling on the PBM model is real.
Medicare Advantage rate compression is the second risk. CMS has been recalibrating MA benchmark rates downward to address overpayments identified in risk adjustment audits. Cigna Healthcare's MA business absorbed significant losses in 2025. If CMS further cuts rates in the 2027 plan year announcement, typically released in March or April, Cigna's guidance becomes immediately suspect.
Scale disadvantage relative to United Health is the structural concern. Optum, United Health's health services unit, competes directly with Evernorth across PBM, care delivery, and data analytics, with a larger capital base, deeper data assets, and better integrated care management. As the managed care industry integrates pharmacy and medical coverage, Cigna's lack of owned care delivery is a growing gap.
Leverage is the tactical risk. Net debt of $23.8 billion constrains balance sheet flexibility. If earnings disappoint and free cash flow dips below $7 billion, the buyback program, the primary EPS growth driver in a low-margin business, faces pressure. Without owned care delivery, Cigna has limited asset-light optionality.
The managed care and health services peer comparison, CI versus United Health Group, CVS Health, Elevance Health, Humana, and Centene. United Health at 14 times forward earnings is the scale benchmark, $500 billion in market cap with the most integrated managed care and services platform in the world through Optum. The UNH premium reflects vertical integration that competitors are still trying to replicate.
CI at 10 times is the cheapest large-cap managed care company in the peer group. CVS Health at 8 times carries significant retail pharmacy headwinds. Elevance at 11 times is the closest peer in terms of employer-sponsored commercial insurance mix. Humana at 9 times has been the most beaten down by Medicare Advantage losses. Centene at 12 times serves primarily Medicaid and marketplace populations.
The sector-wide medical cost issue is real. UNH, ELV, HUM, and CI all flagged elevated utilization in recent quarters. This reduces the probability that CI's discount is company-specific. When the cycle turns, and managed care cycles do turn, the repriced contracts across the sector lift margins simultaneously.
CI's 10 times multiple is partly sector-driven, partly CI-specific. The Evernorth PBM moat is comparable to CVS Caremark and Optum Rx in scale. Cigna Healthcare margin recovery is the swing factor. Whether CI converges toward ELV at 11 times or holds its discount through 2026 depends on Q2 medical costs.
Pre-earnings options positioning was cautious, with a put-call ratio of 1.15, elevated relative to the managed care sector norm. The options market had priced in sector-wide medical cost concerns after United Health and Humana flagged similar dynamics. The implied move was 5 to 7%, and the actual miss triggered a move toward that range as the stock sold off.
The 52-week trading range tells the Cigna story in one number, $239 to $350. The stock peaked near $350 when EPS beats were consistent, then sold off through 2025 as sector-wide medical cost concerns emerged. The current price of $285 places Cigna in the lower half of its annual range. Elevated put volumes at the 250 and 270 strikes reflect institutional hedging of further downside.
Cordani's 2025 compensation includes performance equity tied to adjusted EPS growth. His 16-year tenure provides credibility that the medical cost cycle is being managed. The Q1 miss creates pressure on full-year guidance, and his commentary at the earnings call will set the floor for how much further the stock reprices.
Capital allocation for 2026, $3 to $5 billion in guided buybacks on a $75 billion market cap equals a 4 to 7% buyback yield. At 10 times earnings, buybacks are highly accretive if the EPS base holds through the medical cost normalization. That conditional is what the market is still pricing.
Cigna delivered